What is going on, investors? Hopefully, guys are doing well out there. That is right. It is time for FANG stock earnings season to begin. And we'll kick things off like we always do with Netflix. Ticker symbol NFLX. Over the last year, stocks basically flat, but year to date, it's ripped up over 13%, but really doesn't tell the whole story. Over the last 6 months, this thing's up 40% or nearly 40%. Now, company just reported their Q1 earnings after the bell. It was a miss on the revenue side. It was also a miss on the Q2 guidance as well. We'll get to both of that. Knee-jerk reaction was a 10% downdraft in the shares, but as I am recording this, I'm actually seeing the shares down just 3.5%. Talk about this from a technical perspective as well. Talked about on our Friday show that if you did see a 10% drawdown in shares of Netflix, could create a buying opportunity. We'll talk about if that still stands. Now, the Q1 came in. We'll get through the slides. We'll go through all the pertinent information. They gave us a new chart here. We'll show that. We'll go through the different regions that Netflix operates under, and then obviously the revenue, the profits. It's actually, I can see why the shares are starting to bounce back, and this is what's great as an investor. You can see the knee-jerk reaction of maybe the algo seeing that you missed on the revenue side. The EPS essentially came in line, and the Q2 was underneath guidance, at least on the revenue side. Knee-jerk reaction probably from the computer algos is to sell off the stock. But when you start going through the report, you'll see it's really not that bad. Revenue came in at $8.16 billion. That was just 3.7% growth year over year. We'll come over here and show it to you, but we'll also show you that the expenses kind of on the operating side really stayed in check over at this company. So very impressive in that sense. But what is a little bit disappointing is you have your Q2 revenue forecast coming in at $8.2 billion. Now, some of that is impacted by the old constant currency and the currency fluctuations that you have going on. Obviously, a global company collecting payments globally and then converting them back to the United States dollar does have some problems and has been causing corporates like this some issues on the revenue side and the profit side over the past year or so. $8.2 billion on that revenue side is a little light, though. Wall Street expecting about $8.47 billion. The top Wall Street analyst list, very close to $8.9 billion. The low end estimate on Wall Street was just $8.1 billion. So $8.2 billion for the upcoming Q2. Definitely a little light. Now, the company did announce that they are getting out of the disc mailing business. I didn't know they were still actually in this business. You could apparently still get DVDs mailed to your door. I think they operate under DVD.com, but sometime in September, they're actually going to end that business. So if you're one of the thousands that still get DVDs, you might have other plans here. Might have to upgrade that internet connection. Now, revenue came in at that $8.2 billion. We'll get into that more in a second. Operating income really strong. Look at this, $1.7 billion. That's the highest over the last 3 quarters, although it's a little bit lighter than where we're at Q1 of last year. Q1's a strong quarter for this company. I tell you what, they had $1.9 billion in operating income last year, $1.7 billion. That comes off a quarter where they did just $550 million. Operating margins ticking back up into the 20%. We haven't seen that since last year. Net income coming in at $1.3 billion. When we talk about the upcoming Q2 as well, we talked about how we had about $8.2, maybe very close to $8.3 billion worth of revenue. Operating income looks like it's going to come relatively in line with what you had last year. Operating margins the same. Net income maybe coming in a little lighter, but I tell you what, it's a pretty strong business considering you look at any other streamer from Disney to Prime Video to just about anybody other than YouTube. It's just not profitable. It's not a profitable business. Look at Warner Brothers. This business sucks. And this company is printing net income, operating profits, and strong top-line growth. Now, they are still giving us a global played streaming membership. I think I misunderstood. I thought maybe we wouldn't even get this number at all. It looks like we're just not getting the guidance. They used to give you subscriber guidance for the upcoming quarter, but no, we do still get a subscriber number coming in at 232.5. That was 4.9% growth year over year. We did get some additions there, although it was a little bit lighter than what you had in Q4, but it's certainly better than the negative growth that this company was experiencing in previous quarters. Now, they gave us a new chart here. I don't know how useful this is. It's a weird scale. It only goes up to about 40%. But, and look, this doesn't necessarily just apply to Netflix. The dark red, or kind of the bright red, is Netflix's share in each of these different regions. And obviously it has a pretty strong share there, along with YouTube. I think what this shows is the power of YouTube, number one. It also shows you that Prime Video, which is in green, has a lot of markets that it can likely expand into or potentially expand into. And there's likely some growth here, since again, this scale goes up to 40%. It leaves off whatever the 60%, which may be linear or something like that. There's still a lot of growth, even in these markets where Netflix has relatively high penetration. Now, speaking of high penetration, United States and Canada, revenue coming in at $3.6 billion in that revenue, or in that region. We're seeing that's falling in line. So it's up tremendously where you were in Q1 last year, but primarily due to the fact that you had larger revenue per user. You're at $14.91. That's in dollars. Now you're up to $16.18 and some change. Largely your paid memberships are relatively flat, right around that 73 to 74 million customers here in the United States and Canada. But they've noticed at Netflix, they can continue to raise the price, and those 73, 74 million people continue to pay. So that's a good sign. In Europe, Middle East, and Africa, slightly different story. Revenue coming in at $2.5 billion, which is towards the high end of the 4 or 5 quarters that we have to compare to. But our average revenue per membership actually down year over year to $10.89. Last year, it was at $11.56. So maybe a little bit more price sensitive there in Europe, Middle East, and Africa. And Latin America, potentially also hitting a wall in terms of pricing. You notice last year we're at $8.37. Now you're at $8.60 per user. But that actually fell our paid additions in the most recent quarter. And we're stuck right about kind of $1 billion run rate on this one. And APAC continuing very strong net paid ads. This is the strongest region from a consistently adding new users and new members. But from a revenue perspective, really can't get up over that $9 per membership, at least over the last year or so. Now, come down here to the revenues, $8.2 billion. Last year, you were at 7.9. Last quarter, you were roughly about the same, about $7.9 billion. Now, what I noticed with this company is all the costs relatively in line. Your cost of revenues did tick up from about 4.3 up to 4.8. So those content costs just simply are not going down. I don't think anybody that's investing in this company is expecting that. But look at your marketing costs, almost to $1, exactly the same as it was a year ago. Technology and development up just fractionally, considering all the things they have going on here with the password sharing, the ad-supported tier. They've had to invest a little bit in technology over the last year, and it's done a nice job controlling those costs. And finally, your G&A line roughly flat as well. So that's what you like to see over these companies, as you don't have explosive revenue growth. Okay, 3.7% growth this year, year over year. The upcoming quarter, probably like low single digits. Now, the problem with Netflix is Wall Street has this peg to reaccelerate to double-digit revenue growth, really out for the next year and a half. And I am not confident that this company will actually produce that, but they will likely be profitable, which could get it through some investors and be enough for a lot of investors. Now, $1.9 billion worth of operating income last year, only $550 million in the previous quarter, which was a disaster, but the shares really reacted positively. And operating income this year, $1.7 billion for the Q1. You pay some taxes. Paints a pretty same story. Now, from a balance sheet perspective, very well positioned. Now, they can't go out and bid. Well, it's not that they can't, but they're likely not going to go out and bid on NFL rights or go bid on these live sports that Apple and Amazon and Google are starting to buy up and bid up. But Netflix doesn't really have to play that game. They don't really have to have that live audience eyeballs. They have different types of content that resonates with their customers, and they have plenty of cash, okay? They have positive cash flows, positive operating profits, and it looks like it's going to continue for the foreseeable future. They've got plenty of cash. They noted in these financials they were upgraded to investment grade credit, so they're going to get the best interest rates if they do have to borrow loans. They do have about $14 billion in debt, some of it rolled over to the short-term side. That might come in handy down the road if this company wants to do a large acquisition or something, or consolidate the space. If they're able to do that from a regulatory perspective, having investment grade credit could come in handy down the road. Now, from a cash flow perspective, ooh, look at this. You had nearly $2.2 billion worth of positive cash flow last quarter. It was just $443 million. Last year, it was $922 million. So they blew up those cash flows. Some of it had to do with the fact that you get to add back in foreign exchange losses that you realized over the last year, or really contributed to strong cash flows. The company has very strong cash flows. They barely did any investments in the most recent quarter in terms of property, plant, and equipment, to the tune of just $62 million. They bought back over $400 million worth of Netflix shares. And I tell you what, you got $2.1 billion in operating cash flows, just $62 million in expenditures. Yeah, you can buy back about $400 million of the shares, and the company actually probably can keep that going on. Now, what I'm seeing in the after hours is people are digesting this report. They're saying, this is actually not that bad. Very strong cash flows, a rock solid balance sheet. And while we're not blowing it out of the water in terms of revenue growth, it's good enough. The one thing that we're concerned about, and there's probably more than one thing, but the thing that I think jumps off the page for me is the revenue growth acceleration. I'm just not sure they're going to be able to do this. You're going to be able to go back to double-digit revenue growth all of a sudden in Q3 of this year. I'm not sure what is going to drive that. Maybe price increases, maybe some kind of content they have coming down the pike, maybe. But obviously, that will be something that we have to address at a later date when it comes to Netflix. Now, for a while now, the company almost without hesitation has been making just a beautiful set of higher highs. Now, it has not been confirmed recently as you made some lower lows, but it has to be confirmed, at least from a technical perspective. You need to make some lower lows. Right now, that is still intact. You are still, dating back to like last year, you were making higher lows really almost without deviation. I was interested in this stock just from a shorter term perspective. If we were to pull back down to $300 per share, or about a 10% drop like we saw initially in the after hours, from a technical perspective, right around 300 and change on this stock was interesting. It was a place where you could materialize some higher lows, continue to move higher. Right now, we're in the middle of a range right here at about 340. Overhead resistance is clear at, we'll call it 390, and you have some support below at about 300. Not a strong enough setup for me personally, given the risk, given the valuation, and given the question marks on how in the heck are we going to reaccelerate to 10% revenue growth, other than the comps get a little bit easier, other than FX headwinds get loosened up in the back half of the year? I could see that. But we've got a company doing, $40 billion in revenue on a really, really good day when it comes for a full year. And we've got a $148 billion market cap on this one. Not as expensive as it used to be, but certainly not cheap enough given the growth rate concerns. That's just my opinion. But if you are in this one or you want to get into this one, I wouldn't blame you. And if you want to get into any streaming, especially from a pure play standpoint, Disney's not quite a pure play streamer, but if you look at this one in Warner Brothers or maybe like a Paramount, this one looks the best from a financial perspective. Hopefully you guys enjoyed today's video. Obviously, we'll be back again tomorrow with Tesla earnings and all of the rest of this month with more earnings to come. Hopefully you guys have a wonderful day out there. Good luck with your investments.